Picture this. You're sitting at your desk, sipping coffee, and scrolling through your investment portfolio. Your goal? Growing your wealth while earning passive income through dividends. But here's the big question. Which ETF should you choose to achieve that goal? Today, we're diving deep into two heavyweights in the world of ETFs, JEPQ and SCHG. We'll break it down factor by factor, helping you decide which one aligns best with your investment strategy. Let's get started. When it comes to dividend investing, dividend potential is often the first thing investors look at. JEPQ, or the JP Morgan Nasdaq Equity Premium Income ETF, offers a juicy dividend yield of around 9.56% as of late 2024. That's $5.44 per share paid out over the year. In contrast, SCHG, the Schwab US Large Cap Growth ETF, provides a modest yield of about 0.40%. While JEPQ's higher yield can provide immediate cash flow, it's important to evaluate its sustainability and how it aligns with your overall financial goals. Remember, high yields can come with higher risks, so it's essential to dig deeper into the trade-offs. Another critical factor to consider is expense ratios, the hidden cost of investing. JEPQ has an expense ratio of 0.35%, meaning you're paying $35 annually for every $10,000 invested. SCHG, on the other hand, is significantly cheaper at just 0.04%, or $4 for every $10,000 invested. Over time, lower expenses can make a big difference, especially if you're reinvesting dividends or compounding your growth. This cost efficiency makes SCHG a compelling option for long-term investors focused on maximizing net returns. When it comes to performance, the story gets even more interesting. In 2024, JEPQ gave one-year annualized return of around 25%. This is largely due to its covered call strategy, which thrives in volatile markets. Meanwhile, if we analyze the performance of SCHG from February 2010 to December 2024, it has given yearly return of 16.88%, reflecting the long-term growth potential of its large cap stocks. JEPQ's short-term outperformance can be appealing for those seeking immediate results, but SCHG's steady growth over time makes it a strong candidate for patient investors. Performance metrics provide valuable insights into how these ETFs align with different investment horizons, so it's crucial to match them with your personal timeline. Let's dive deeper into their investment strategies. JEPQ employs a covered call strategy, selling call options on the Nasdaq 100 index to generate income. While this caps potential capital gains, it provides consistent cash flow and reduces volatility, making it an attractive choice for income-focused investors. In contrast, SCHG focuses on large-cap growth stocks like Apple, Microsoft, and Tesla. These companies are known for reinvesting profits to drive growth, which can lead to significant capital appreciation over time. This distinction highlights how these ETFs cater to different investor objectives. One prioritizes income, while the other aims for growth. Risk is another factor that cannot be overlooked. JEPQ's strategy makes it less volatile than pure equity investments. By selling covered calls, it smoothens the ride during market downturns, offering a buffer against steep losses. SCHG, however, is exposed to higher volatility because it's concentrated in growth stocks, which tend to fluctuate more during market swings. For example, during the 2022 market correction, growth-heavy ETFs like SCHG experienced sharper declines compared to income-focused strategies like JEPQ. Your risk tolerance and ability to weather market volatility are key considerations when choosing between these options. Sector exposure adds another layer to the comparison. JEPQ is heavily weighted towards technology, reflecting the Nasdaq 100 index it tracks. This means its performance is closely tied to tech giants like Amazon, Meta, and Alphabet. SCHG also has a significant tech weighting, but is more diversified across sectors like healthcare, consumer discretionary, and financials. This broader diversification could make SCHG a better choice for investors looking to mitigate sector-specific risks. If you're aiming for a balanced portfolio, understanding these sector allocations is critical. Tax implications are another area to consider. JEPQ's covered call strategy can generate higher taxable income due to short-term gains. These gains are typically taxed at a higher rate compared to long-term capital gains. SCHG, on the other hand, focuses on growth stocks, often deferring taxes since most gains come from capital appreciation, which is only taxed when you sell. Depending on your tax bracket and investment strategy, this could be a deciding factor. It's always a good idea to consult a tax professional to understand how each ETF fits into your tax planning. Liquidity is also worth mentioning. SCHG, being a long-established ETF, has higher trading volumes, which means tighter bid-ask spreads and easier trading. JEPQ, while newer, is gaining popularity and has reasonable liquidity. If you're an active investor who frequently buys and sells, SCHG's higher liquidity could be a significant advantage. For long-term investors, however, this may not be as critical, but it's still a factor worth noting. Let's not forget about fund size and longevity. SCHG has been around longer and manages a larger pool of assets, 38.4 billion AUM compared to JEPQ's 21.4 billion. A larger, older fund often indicates stability and investor trust. However, JEPQ's rapid growth in popularity shows its appeal to income-focused investors. While SCHG's established history provides a sense of reliability, JEPQ's innovative approach and strong recent performance make it an intriguing option for those seeking higher income. One final consideration is how these ETFs fit into a broader investment portfolio. For example, if you already have significant exposure to growth stocks, adding JEPQ could help diversify your income sources. On the other hand, if your portfolio is income-heavy, SCHG might provide the growth potential you need to balance things out. Think of these ETFs as tools to complement your overall strategy rather than standalone solutions. So, what's the final verdict? Well, that depends on you. If you prioritize high income and lower volatility, JEPQ might be the right fit. If you're aiming for long-term growth with minimal expenses, SCHG could be a better choice. Remember, there's no one-size-fits-all solution. Your investment goals, risk tolerance, and time horizon should guide your decision. Take the time to evaluate these factors, and you'll be well on your way to making an informed choice. Thanks for tuning in. Don't forget to subscribe Finance Flowchart and share your thoughts in the comments below. Happy investing, and we will see you in the next video.